Hello, I hope everyone is having a great start to their summer. As we look back into the second quarter of the year, one of the main stories continued to be inflation. As we spoke about in our last quarterly video, quarter one we saw inflation begin to increase slightly. Well, quarter two we saw that trend reverse and we saw inflation begin to pull back again slightly. This has led to the markets projecting the Federal Reserve to cut rates one, maybe two times by the end of the year, with the first rate cut expected to be in September. This is in stark difference to where we started the year, where the markets were projecting the Federal Reserve will cut rates 3 to 4, or some people even said even 5 times, with the markets projecting that the first rate would occur in March. So with the Federal Reserve focus on inflation, people need to remember they also have another mandate, and that is unemployment or maximizing employment. Since the COVID recession, the labor markets have been very strong. Recently, they have begun to weaken or soften a little bit. We've seen this from going from the historically low unemployment rate of 3.6, having it increase to its current of 4.1. That increase is, while keeping it at a historically relatively low rate, has started to result in the Federal Reserve to mention that softening of the labor markets could be another reason why they would start cutting interest rates. So the good news for the market is that the Federal Reserve appears to be looking for a reason to start cutting interest rates. The other story that has continued is the bull market in the stock market, particularly within the tech sector. The tech sector has continued been led by firms that have a strong presence in AI, and this has led some people to start wondering, is this going to be another example of the dot-com boom we saw in the late 90s, early 2000s? One of the big differences between the dot-com boom we saw over 2 decades ago and the current stock market is, during dot-com, pretty much any company related to tech industry saw exponential growth. Conversely, today, it's really a handful of companies that are being pioneers, the NVIDIAs, the Googles, the chip makers that are really leading the rally. As a whole, we're also seeing the valuations are about a third lower today than they were during the tech bubble. So something keeping an eye on, but something that is not something to be concerned or start raising red flags. A lot of times, a lot of pundits just like to make correlations or stories about how this market is similar to a previous market and leave out a lot of context. Another big story that is going to continue throughout the year is going to be the upcoming elections. In terms of the number of seats in Congress on the ballot, it's going to be one of the largest elections in American history. As we spoke about in the past, our job is to stay above the noise and not get caught up in any of the rhetoric. The historical data shows that the months following an election, regardless of the outcome, that the market tends to perform very similar. So while elections are very important and can have major ramifications from a policy standpoint, from a stock market and investment standpoint, we want to make sure we don't let our political views or opinions start dictating too much on how we make investment decisions. One of the things looking forward is, if the Federal Reserve begins to cut interest rates, what will happen to the bond market? As we experienced in the past several years, when interest rates are increasing, the value of bonds fall. And then the opposite, when interest rates are decreasing, the value of bonds increase. A lot of people have been holding a lot of cash in high yield savings or short-term CDs, where they've been able to earn 5% or a little bit more. Now we believe it's the time to start considering, do we start looking and going into longer dated bonds? Do we start trying to lock in some of these higher rates at longer terms before the interest rates begin to get cut. Because once interest rates begin to get cut, that bond that you're holding at 5%, you might not be able to reinvest and get a similar rate. So another area that I think is very important is how everyone is managing their cash and their short-term bond allocations. As we continue to look forward into the year, we will remain focused on adhering to sound investment principles, not getting caught up in any of the hysteria that will be associated with the elections or with news that comes out. As always, if you ever have any questions or concerns regarding the markets, your portfolio, or the economy, always don't hesitate to reach out and give us a call. Hope everyone has a great summer.